Hello traders, Gary Wagner here just after 11 o'clock in Honolulu, 4 o'clock in New York. It is Thursday, 23rd day of February 2017, and this is the Daily Report for Gold and Silver. Wow, what a dynamic breakout witnessed today in the precious metals markets, with gold trading substantially higher on the day and breaking above our current level of resistance that we have pegged at 1242. Market up about $16.50 today at 1249.80. About a 1 1/3% rise in terms of direct value. And we did send out a trade alert this morning recommending the initiation of long positions in gold. Of course, we will cover that in detail when we pull up our first chart. In terms of net changes on the day, as I said, closed at 49.80. Now it traded to a low of 1236 and a high of 1252. So we're just about $3 off of the high. And this in response to two major factors: a weakening US dollar and trader sentiment shifting as the Fed minutes, which were released yesterday, have been digested by traders. More on that in a bit. Silver also showing a dynamic upside move today. Not nearly the size of gold in terms of percentage gain. As you can see, silver trading up about 1%, but it is a sizable move, taking our current spot price to 1817, and that puts it up about 16 cents on the day. As we said, a lot of this in response to the US dollar. Now, the US dollar has come off of the lows at 100.87, currently trading at 101, putting it down about 0.2%. So traders, absolutely no doubt, a strong, sizable upside surge in gold pricing, moving it above a resistance level that we identified roughly from, call it 1239 to about 1242. It's where these tops come in that we can see on this daily chart over the last week and a half. We talked about the fact that there have been two occasions in which gold prices and traders attempted to breach this strong level of resistance, but in both occasions, absolutely unsuccessfully. We also talked about the fact that our parameter to enter our next trade was a substantial break above this resistance level and a close above this resistance level. We met that criteria today, and that was one of the primary reasons that we went out and issued a trade alert that we sent out this morning, both through text message on your phone as well as an email. For those subscribers that have not set up the SMS text service, there's absolutely no charge, but you'll do that from the home page at thegoldforecast.com. And traders, when you go to the home page, the front page, I should say, you're logged in, you will see a series of tabs on the right-hand side. You simply want to click this Manage SMS, and that will allow you to set up the service to get trade alerts to your phone. So traders, one of the, not so much caveats, but one of the instruction sets that I did send out to you is because of the fact that we had such a dynamic spike, and that spike took gold pricing so far over this resistance level, that I wanted you to buy at the market, because if it doesn't pull back, we want to have some position at the best possible price. But I believe that there's a high likelihood that we'll see some sort of a dip at some point, and so to reserve part of your capital to add to that position at a later date, to either buy on a dip if the market comes back down, or to buy at our next price target. And I also made the recommendation to place stops below 1216. And stop placement is basically set to be below the most recent lows, which, as you can see, occurs on this particular candle, and this candle's low is approximately 1216, and that's the rationale behind placing our stop where we have. You should be long gold, stop should be in place. So the important thing now is to talk about our exit strategy and upside target. And traders, that's where it really begins to get fun. That's the inner geek within me. But our upside targets are going to be Fibonacci based, and we're using Fibonacci extensions really to give ourselves kind of benchmarks. And the way we want to do this is to use a basic Elliott wave model and look at our wave count, this being labeled as a wave 1. Of course, that's after hitting these lows last year, end of December. Market goes to that final bottom just above 11.20 per ounce. From there, it rallies approximately $100 to about 12.20 per ounce. From there, we then have a 38% correction, and that takes us to 11.80. I believe this concludes a wave 2. I also believe we are now in wave 3, and we are looking at a subcount behind that wave 3, which is the recent activity that we witnessed. In other words, the beginning of this rally took the market from 1180 up to a 61% extension, and that's an extension of this wave 1 here. We then had the market soften a little bit and correct. We also had some real resistance that, as you know, came in approximately at 1242. Now, Elliott wave modeling states, in terms of the 3 primary rules of a wave count, that wave 3 can never be the shortest of any of the impulse waves. You have a series of waves 1, 2, 3, 4, and 5. And so wave 1, wave 3, and wave 5 are going to be impulse waves, and your counter waves are going to be 2 and 4. So we're focusing on this wave here, 3, that cannot be the shortest of any of the waves. So that means, in terms of a model, the first target that we would have would be a 1-to-1 relationship or a 1-to-1 extension between this rally here and our current rally, and therefore our target is approximately 1280. That's based upon a 1-to-1 relationship. However, in a strong market, you're not going to get a 1-to-1. You might get a 1.23 or a 1.38, as much as a 1.618 extension of this rally. So although our first target is to initially see this market rally roughly to about 1280, I think that there's a couple other benchmarks that we'll hit along the way, and we won't run into any really strong resistance once we break above this 1250, which, as you can see, is a technical level of resistance based upon this action back in October. I do not think that that's going to really be an issue, and I think that once we break above this, we will look, if we don't get a dip, here's the area that we would look to add with the exit strategy of about 1280. However, I do believe we could see the market run a little bit higher, and my upside target that I believe has good potential is about 1300 to 1313. The level that I believe that this rally almost has to move to, based upon our modeling, has got to be about 1280. Traders, maintain your current long position, maintain your current stop, look to add to that long gold position on a dip if we are fortunate enough to see this market kind of backtrack a little bit before moving to higher ground. So traders, in other markets that we follow, we have this unique scenario today in which risk on and risk off asset classes are running in tandem. They're both running to the upside, with U.S. equities, specifically the Dow Jones Industrial Average, trading to a new all-time record high, and gold, safe haven assets, also running substantially higher on the day. Now, nominal move in the Dow, but it's above 20,810. That's our current print, with a low of 20,746. We had kind of a mixed bag, with the Standard & Poor's trading off slightly, off really a nominal amount. I'm going to label this as unchanged at 2362. And then when we look at the NASDAQ, that also trading off, but here we do have a decline of about 0.33%. NASDAQ, these tech-heavy stocks have been running so aggressively and so strong to the upside that it doesn't surprise me that a little bit of profit-taking has entered into the market. Lastly, do want to look at crude oil. In terms of crude oil pricing, it continues to trade sideways, but with a strong bias to the upside, now trading at the upper ends of the range at 54.35. So as I talked about in the opening letter, on rare occasions you will see a tandem run of risk on and risk off asset classes moving together. The example that I cite, of course, is 2008, 2009 when they initiated quantitative easing and you had gold run to its all-time historical high and equities run to their all-time historical high up until about mid-2011. At that point, equities continued to move higher, but gold fell out of bed and retraced very hard. As we look at this market, we've got a new high, but we also have a doji. That doji represents either consolidation in the market or a potential key reversal. You will typically get key reversals when you have a green candle, a doji star, and then a red candle. That, of course, is a three-river evening star. Now, we could be looking at consolidation, or we could be looking at some potential point in which the market can correct. This is one strong market, but strong up means strong down. We certainly want to keep our eyes peeled to what equities are doing. Now, today we once again saw a resurgence of downside selling pressure in the dollar. And as you can see, I pulled up a basic dollar chart. This is daily, and in there I've got channel lines, and these channel lines show us that ever since hitting these tops above 103, the market has had a bias to the downside, and within that bias, it seems to be trading within this channel, this moving to the bottom of the channel, and this most recent move back up above 101 to the top of the channel. Based upon this study, if the market, of course, breaks out and above this level, it would negate what I'm about to say. But the most likely scenario, I believe, is to begin to move back down through this channel. It seems as though this is what we have been witnessing in the dollar. Of course, a weaker dollar is going to be extremely supportive of gold. And crude oil had a strong move today, moving back towards the upper end of the range, 54.35, moving up about 1.5%. However, the caveat to oil right now, and we're looking at oil through a weekly chart, and as you can see, I've created the channel lines, which absolutely indicate two things to us. First of all, that this market has been moving with a bias to the upside, and that is at least since call it the last quarter of 2016. At the same time, we must acknowledge that for the last couple of months, in other words, when we look at February, January, December, through November, even though there's been a slight upside bias, the overall characteristics has been a sideways market with highs just at around 54 and lows at around 52. And that's the reason that I haven't put out any kind of a recommendation in oil in terms of where I think it's going to go long term. If push comes to shove, I believe the bias will continue to the upside. I believe that 58 will be 58 to 60, I should say, will be an absolute ceiling to the market if it gets that high. And I believe that it will probably continue to trade in this channel, which means you could see more upside action, or you could see the market move back to the bottom of this channel. The key to the oil market right now is sideways, without a question of a doubt. So traders, absolutely no doubt, the particular setup that we were waiting for, which was for gold to effectively trade above and close above resistance at 1242, was met. That was the primary rationale behind initiating our long position in gold. But from comments that I made when I sent out the trade alert, as well as commentary on today's show, we want to reserve some capital, because my belief is we'll probably see it weaken maybe tonight, maybe tomorrow, a little bit as some short-term profit taking ensues, and then add to that position at a more effective price. If we're wrong and there really isn't any kind of a dip to add, we will add to our gold position, but we'll add on the way up. We'll scale in on the way up, adding a position at our first benchmark level that we're hoping to achieve. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review.